Greetings, Doug at Community Lending Group. So you're thinking of building a new home or maybe even remodeling your existing home. Which do you need? Do you need a construction loan? Do you need long-term financing? Or do you need both? Boy, that's a great question. And so for today's mortgage moment, we're going to discuss the difference between long-term financing and the construction loan and when you might need to use both. So let's start by defining what each one is. A construction loan is a short-term financing option designed for funding the construction or renovation of a property. They have a short term of typically between 6 to 12 months. They do require a larger down payment of between 20 to 25%, but the equity from your lot or your home can count towards the down payment. Now, the rate will be variable and typically requires the borrower to make interest-only payments while the project is being completed. Now let's compare that to permanent financing. This is long-term in nature and pays off the construction loan once the project is completed. Permanent financing runs between 10 to 30 years in length. One of the advantages of long-term financing is that it only requires as little as 3% down on a conventional loan or 3.5% down on an FHA loan. Now, although variable rates are available, most permanent finance loans are typically fixed rates and do not adjust. And finally, most permanently financed homes require both a principal and interest payment to be made each month. Now you know the difference between these two loans. Let's take a look at 5 of the most likely scenarios you might be considering. Now, if you're looking to buy an existing home, you will only need long-term financing or permanent financing. If you're having a home built by a builder within the builder's project, then typically the builder will provide the construction loan, and all you'll need to do is get pre-qualified and then have permanent financing for when the home is completed. Next, if you're having a home built on land that you either own or purchased that's not part of the builder's project, then typically the builder will require that you obtain the construction loan. Then once the project is done, you will need to refinance into a permanent long-term financing. Next, if you're remodeling your home and you can refinance prior to having the home worked on, then you only need permanent long-term financing. The refinancing, however, must be completed before the project can start. And then lastly, if you're having your home remodeled and the current value of your home is not high enough without the new improvements to pull out enough money needed for the remodel, then you will need a construction loan. Now, this construction loan will pay off any mortgage you might have and provide the funds needed to complete the project. Now, the value of the home will be based upon future value when the project is completed. Then once the construction is just about done, you'll start the process of long-term financing to pay off the construction loan. Now, every situation is a little bit different, and we didn't even go over all the options. I mean, for example, I didn't discuss the one-time close, which is a great option, but I'll save that for another video. But if you have any questions on what would work best for you, give me a call. I'd be more than happy to run through the different options. This is Doug with Community Lending. Thanks for watching, and we'll see you next week.